So in the last session we went through and looked at your dividend policy, whereby we looked at Modigliani and Miller's theory, whereby the pattern of your dividends was irrelevant, provided that you invested in those positive NPV projects. And then we looked at the traditional theory that says that the dividend is vital in terms of performing a role within your business. It signals confidence to the markets if you are able to establish a dividend policy and stick to it year on year. Key thing is that we went through there, particularly when we looked at Modigliani and Miller's theory, is that we went through and said that you have to invest in those positive NPV projects, in which case you needed to invest that cash in a project at the company's weighted average cost of capital to ensure that you were able to meet the returns for the debt holders and also pay a dividend to your shareholders. What this session goes through and looks at now is a recap again of what you've seen from the days of F9, whereby we're going to look now at your gearing theories, whereby we have to look at what's going to go through and happen as we go through and take on board more and more debt, as we go through and increase the level of gearing. If we change the level of gearing, how will that go through there and change my weighted average cost of capital? So before we go through and look at your weighted average cost of capital in any detail and how that impacts on the gearing, let's just see why that's important in terms of looking at the value of your business. Because if we think about the value of my business as a series of constant annual cash flows starting in a year's time and carrying on forever and ever and ever in perpetuity, and assuming that there is no growth, then the market value is simply your cash flow multiplied by your perpetuity factor, which will be there 1 over your discount rate. Here, the discount rate being your weighted average cost of capital. Well, what's going to go through and happen there? Basic theory then dictates that if your weighted average cost of capital increases, then what will happen there is that the market value of your company will decrease. Conversely, if your weighted average cost of capital decreases, then what's going to happen there is that your market value will increase. Now, what we need to be able to look at is how will that weighted average cost of capital change with the level of gearing. So if we go through and have a look at what your weighted average cost of capital formula is, again, it's something that you should be familiar with from the days of F9, but let's write it down just to make sure. Because you've got there the market value of your equity multiplied by the cost of equity plus the market value of your debt multiplied by the post-tax cost of debt to the company divided by the value of equity plus the value of debt. Remember, those values of equity and debt should always be there at market values. Now, what we need to go through and do is look at, if we go through and change the level of gearing, how that will go through and change the level of your weighted average cost of capital. And it's split into two ways. Think of it as a set of scales. Because what we're going to look at first is if we take on more and more debt, then what's going to go through and happen is that the weighting of that debt is going to go through there and skew more towards our cheaper cost of debt. Remember, debt is cheaper than equity, as firstly, it has less issue costs, and two, maybe more importantly, the tax savings that we generate on the interest bring more benefits to the shareholders, ultimately making it cheaper than the cost of equity. So what's going to go through and happen is if we start skewing your weighted average cost of capital more towards our cheaper cost of debt as we have more and more debt, then what's going to go through and happen is that your weighted average cost of capital is going to go through and decrease. Now, if that's the case, if your WACC goes down, then the market value is going to go through and increase. However, what we then need to start to think about is the fact that we take on board more and more debt. Remember that debt gives rise to fixed interest payments. Now, fixed payments are inherently more risky as they are obligations that must be made. If we don't have the cash available, we can't make those interest payments, and subsequently the company could be wound up. So what's then going to go through and happen is that as the more debt we take on board, particularly at high levels, the equity holders will get more and more worried as they are concerned about their increased level of risk. If you want to be specific, your increased level of finance risk. So your cost of equity begins to increase. And as your cost of equity begins to increase, if you like, the scales start to balance up. It starts to pull back that weighted average cost of capital more towards the higher, more expensive cost of equity. So therefore, what begins to happen is your weighted average cost of capital will begin to increase. What we need to look at now is how does that balance up? Is there a point whereby we can find the optimal capital mix? The optimal capital mix is very difficult to find in practice. However, what we can do in the exam is talk about the different theories that we have. You've seen them before, so I won't talk about them in too much detail. We'll get through them relatively quickly, but you should be able to remember that we've got the traditional theory, we've got Modigliani and Miller's theory from 1958, which is sometimes more easily referred to as the no tax theory on gearing, and then we have their later theory whereby they go through and start to incorporate tax. Now, you'll have seen M&M with tax, M&M without tax, as we said in F9, and you'll have seen it there in terms of numbers, just to go through and demonstrate the principles and how it works. Here, I'm going to leave the numbers to one side. It's purely a discussion element that we're going to focus on in the exam. Your traditional theory on gearing harps back to what we were talking about a very short moment ago, when we spoke there about as we increase the levels of debt, then we skew the weighted average cost of capital to the more market value worth of your debt. So therefore reducing your weighted average cost of capital. At high levels of debt, shareholders get worried and they then demand more return for the higher level of risk that we have, which can be demonstrated by the graph that we have here. Because what we can see there, if we look at it in 3 steps, firstly, what we have there is you can see that your cost of debt is very constant. It does not change because that return to the debt holders is fixed. The only time it goes through and increases is at very, very, very high levels, when we run the risk of bankruptcy. Therefore, they have more risk and demand a higher return. We've also got there your cost of equity. So you can see there at fairly low levels of gearing, your cost of equity remains fairly static. It doesn't change because we're introducing the benefits of cheaper debt finance. There's tax savings, so therefore more cash available to the shareholders. However, as we said, at higher levels, the return required by the equity holders increases as you've got a higher level of risk. What you've then got is to balance it all up and bring it all together is your conclusion. The conclusion is that there is an optimum level of gearing, an optimum finance mix, whereby if you can find that level of gearing, that will give you the minimum weighted average cost of capital for the business and ultimately the maximum valuation of your company. It's that point that business directors strive to achieve, but again, it's very, very difficult to achieve in practice. Modigliani and Miller's theory of 1958 makes the key assumption that there is no tax. So therefore, there will be no tax saving on any interest that a company goes through and pays. And ultimately, what this then led us to, when we looked at the numbers from the days of F9, I always looked at it and thought, Modigliani and Miller and the world of straight lines. Because every line that we have for your cost of equity, for your cost of debt, and for your weighted average cost of capital is there as a straight line. So as you can see, again, what we have here is that your cost of debt remains static. It does not change. What you will also note there is M&M also assumed that there was no bankruptcy risk. So there's no flick at the end of your cost of debt at high levels of gearing. We go through as well and we assume that your investors are rational. So as we take on board more debt, they will demand an increased level of return to compensate for the extra risk that is being taken on board. Based upon the numbers, what we were able to see when we looked at it in F9 was that your weighted average cost of capital remained exactly the same. It did not change regardless of the level of gearing. So the key conclusion there is that it doesn't matter the level of debt that you have within the business, the value of your company is not going to go through and change. However, when we go through and look at M&M with tax, so when they incorporate the tax savings, what happens there is that there is benefits from taking on board the cheaper debt. We get the tax savings on our interest. So what we have here, again, your cost of debt is at a constant. You may just notice that it's ever so slightly lower than the cost of debt that we had before when we looked at the no tax scenario, as now it's cheaper, so therefore the cost to the company is less than what we had before. And then what we have as well, same rational investors, so we get a linear response there in terms of my cost of equity, which increases as we take on board more and more debt. But due to the tax effects, the tax savings, sometimes referred to as the tax shield on your interest, what happens is the weighted average cost of capital will go through and decrease. As we are getting more benefits to the business, we've got more cash as we are saving tax on the interest, so there's more cash in the business, so therefore a higher value of that business. So your weighted average cost of capital is going to decrease. And what we have there as a conclusion is that you can go through in a world of tax and gear up as highly as possible, because then you will go through and get the maximum value of your business. However, we need to look at this in a little bit more detail, because there are various practical aspects that we can go through and look at. The practical aspects, first of all, look at the business risk of the company currently. Because if you're already a highly risky business, maybe you operate with an already high level of fixed costs, you don't want to go through and take on board more debt, because that will go through and impart more fixed costs into your business, and therefore you'll end up with even more risk. So what we're saying there is you don't want to pile risk on top of an already risky business. We also need to go through and consider bankruptcy. If we think about bankruptcy, at high levels of gearing, there's a significant risk of bankruptcy. If we incorporate bankruptcy into Modigliani and Miller's tax theory, then what would go through and happen is that your cost of debt would begin to increase, your cost of equity would begin to increase, and then also your weighted average cost of capital would increase, and therefore we end up again back to your traditional theory, whereby we have a minimum weighted average cost of capital, albeit at a much higher level. We also need to consider tax exhaustion. If you have high levels of debt, you'll have very high levels of interest, and potentially that interest could go through and wipe out your taxable profits. At that point then, all your tax has been exhausted, and any extra interest that you pay, you won't get the benefits of the tax savings. We also need to go through and consider the quality of your assets. If you think about debt, we need to go through and have security for that debt to make it cheaper. Now, if you haven't got some good quality assets, so your land and buildings are in a state of disrepair, then what's going to go through and happen is you won't get as good rates on your debt as what you previously were able to do. If that's the case, it will make your debt more expensive and have an impact then upon your weighted average cost of capital. We've just been speaking there about debt. However, as well as just debt and equity, there are other forms of finance that you can go through and consider. There might be the option to lease assets instead of buying them outright. You may even be able to go through and get some form of government grant to help you with your project. So whenever you're answering questions on gearing theories, always think as well about the availability of other sources of finance.